Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, July 22nd, 2017. First of all, I wanted to apologize. There's some background noise. It's because I'm traveling and I'm recording in a different place from where I normally record, so I do apologize for that. So first of all, let's look at what we have coming up. We have VIP membership interest list that's forming. I already mentioned it last week. Estimated go live time is September 18th. We're going to look today at landscapes in the stock market in 2000, 2008, and currently in 2017. What are the differences, and are we possibly headed back into the bear market, or is there anything to worry about? S&P 500 is at record high, advanced decline line also is at record highs, so we'll look at bearish patterns in bullish instruments and where do they go. Many sectors are in the middle of oversold bounces, and some are already at fresh record highs. Emerging markets and Europe is at 52, actually at multi-year highs. Solar ETF 10 hits 52-week highs and outperforms. Junk bonds are confirming the bullish posture for stocks, while investment-grade bonds are also bouncing. And dollar actually hit 52-week lows, so that's a big development. This is of course helping gold and gold miners. Oil may have already failed, but we can still continue higher to around 50 bucks, and we'll look at XLE as well. And while at the same time natural gas is pretty much flat for the week. So let's look at the differences between today's posture in stocks and that preceded the previous two bear markets. So first let's look at 2001, and this is a weekly chart, and here I have two generic exponential moving averages. Please note I do not use this particular pair, but they're just good for illustrative purposes only. So here's a 10-week and the 35-week exponential moving averages, and notice that we have a bearish cross here in 2000, end of 2000. Now what I do have is I have developed my own a market breadth index, which helps me determine whether or not S&P 500 and by extension United States stocks are in a bull or a bear market. So here it is, market breadth index, and it goes from 1 to 5, and when we hit 1, that means we are in a bear market. So notice here this indicator hit 1 at end of 2000. But even before that, I have another set of indicators. It's called raw MBI, which is basically percentage of stocks within the S&P 500 on a buy signal. And notice here we basically dipped below 40, and we were never recovered above 80. So here we have all three indicators pointing to the downside. And notice that even though those were multi-year highs at the time, eventually, literally within a week or so, a couple of weeks or so, we rolled over into a bear market, which was confirmed by multiple indicators. A similar picture, but more abrupt, happened in 2008. Notice that here the raw MBI percentage stocks in an uptrend changed to a bearish pattern very abruptly, following a crossover in the exponential moving averages, and the total market breadth index followed suit very quickly. So this was a very abrupt move, and this was a true bear market that was very quick and painful, basically. Now let's look at what we have currently. Now currently this is 2017, and notice that we have not even remotely a picture which I showed you in 2007, 2000. Notice that the two exponential moving averages, the 10-week and the 35-week, are both pointing higher, and the 10-week exponential moving average is actually well above the 35-week exponential moving average. Additionally, the market breadth index is at 5. This is as high as it goes, and it turned 5 back in 2016. And also the raw MBI, a percentage of stocks in an uptrend, is currently around 76%. So right now, the posture could not be more different than when the bear market hit back in two previous examples. In other words, I think that right now the stocks are firmly bullish, and there is not that many indicators that we will roll over back into a bear market. Okay, let's look at more zoomed in version of S&P 500. This is S&P 500 SPY ETF on daily time frame. Thursday here we have fresh all-time highs. Pretty much self-explanatory, very bullish posture, very bullish chart. Now, to me, a very important thing that occurred to this week was that we have confirmation from advanced decline line, and additionally, what was really good is that we had confirmation from advanced decline volume line. So we have fresh all-time highs in both of these indicators. So to me, this is looking very bullish. I mean, of course, we are overextended as usual, but then again, overextended in a bullish security doesn't mean much. So we should be looking for bottoming patterns, not topping patterns, because maybe 50 times during the bull market you will look for bottoming patterns, and only one time you will actually get a bearish pattern that will actually work out, and we will get a true bear market afterwards. But generally speaking, I would not be shorting this chart, obviously. Here's S&P 500 on the weekly time frame. Notice we had triangle consolidations here. First one a few weeks ago in June kind of didn't go anywhere. We had a little bit of a bearish candle, but really didn't go anywhere down either. And then we had another triangle consolidation, and last week we had a breakout, bullish breakout, and now we have a follow through to the bullish breakout. So this chart is actually really good as well. I think it's a very strong bullish chart. Here's QQQ, and this one kind of bore the brunt of selling. Notice here in June 11th, I believe here, we had this big bearish red candle on enormous volume, and then another enormous volume the next day afterwards. If you listen to my previous videos, you will notice that I actually pointed out this enormous volume as most likely. I was saying that QQQ has already bottomed, so those two candles were pretty much it. We kind of came a little bit further down, not by much. Most likely it was just a market maker maneuver. They were trying to take out the stops below, 137.12 here from mid-June lows. So they succeeded. There was several, even a close below a June low, and then it's just a strong rally that took us to fresh all-time highs. All-time highs in QQQ speak volumes. Here I also showed that we are sort of oversold already back in July. This is intermediate term Bread's momentum oscillator. It's available on StockCharts.com, and here's the symbol ITBM, RA, and DX. Kind of useful. So it was already oversold, so obviously people started buying. Here's QQQ on a weekly time frame, and this is why I repeatedly warn new traders from shorting bullish charts. So what do we have here? We have not one, but two bearish engulfings. In fact, this bearish engulfing in the beginning of June was a true bearish engulfing, because we had a bearish engulfing outside reversal kind of business, followed by a red candle. So it was definitely confirmed bearish engulfing. Notice what happened. Didn't really happen much. We just kind of moved back and forth, but then we made fresh all-time high. So bearish engulfing, bearish patterns for that matter, in a clearly bullish security usually don't amount to much. Occasionally there will be a true bear market afterwards, but it happens quite rarely. So instead of trying to look for, oh look, we're topping out here, we could continue strongly higher. I mean, we could have another huge bubble of 2001 proportions. we haven't even begin to being over, dangerously overextended. So again, instead of trying to find the top in a clearly bullish chart, try to find the bottom in a clearly bullish chart and look for entries in the long side, basically. And this is what we do at MasterCharts Trading. In fact, we opened the position in QQQ, and now we're at first target already. So IWM, this is Russell 2000. Another thing that I try to caution against is reading too much into divergences. Here's a divergence. We have higher highs in IWM. We have lower highs in RSI. This is RSI. Notice that we're making lower highs, but we continue making higher highs. This is just an artifact of computation of RSI. So should we worry about it? I don't. Some people try to read a lot into it and try to see, oh, maybe this is some sort of a divergence and maybe eventually we will roll over. But what if RSI makes a fresh high, above previous highs? I don't know. That's why I'm trying to say that basically I'm not trying to find the top in a bullish chart. I'm trying to find bottoms in a bullish chart. New York Stock Exchange Composite, pretty much one of the the broadest market indices out there. Here's another divergence. We're making higher highs on NYSE, but we're making lower highs on bullish percent index and percentage of stocks above 200. Didn't really account too much. We made fresh highs, all-time highs here. Important on this chart to me personally is that we have confirmation from advanced decline line and from advanced decline volume line. These are fresh all-time highs. So this is good news. To me, it makes me feel comfortable and fuzzy, I guess. Dow Jones Industrial Average, fresh all-time highs on advanced decline lines. Also very strong charts. I actually myself still have a position open in Dow Jones DIA, and this seems to be continuing higher, so no point selling it. Here's XLY, the consumer discretionary. Notice that here we are making lower high, but we already made fresh all-time highs on advanced decline line. So this is a bullish divergence in my opinion. Again, don't try to trade off of those divergences. This is just something to keep in the back of your mind, saying, to the extent of you are confirming your bias, and my bias is bullish. So we opened position also in XLY, and we're gaining pretty nicely. XLI Industrials, also all-time highs. Advanced decline lines also hitting all-time highs. This is one of the strongest sectors right now. XLI. XLP, deeply oversold sector. I opened myself to recently XLP, and we are now moving higher in advanced decline lines. But I think the important thing is that this was clearly oversold. And if you're trying to read, maybe this is a reversal. One day there will be a reversal, but I don't think it's there yet. Utilities, same thing. Very, these are all-time highs. Deep pullback, sure. Is it a reversal? I doubt it. And now we have a surge higher and really nice bullish candlesticks. There's a gap right there also. This is a good-looking bullish chart in my opinion. And here's some foreign stocks, emerging markets, EEM, diversified emerging markets. Very strong chart also, multi-year highs here. There's really not much you can say about it. And also notice that it's now in a top performing sector, top performing ETFs. Europe, VGK, also multi-year highs on the heels of Euro gaining strongly, and Euro is hitting 52-week highs. So also very strong chart, and again, I would not look for top-end patterns. I would look only for bottom-end patterns. And finally, here's 10 solar. If you listen to my previous videos, I was saying that I actually have a position open. I showed where it is already. I opened it somewhere around here. I don't remember exactly where, but I still keeping it open, and now we're at 52-week highs, and I think this is very good news because we could easily continue higher. We're still, you know, I think this is just the beginning of a bull market in solar stocks. I mean, this is a monthly chart. These are all-time lows, and these are only 52-week highs. So we could easily continue higher from here. So, anyways, to summarize, the stock market is bullish, I think, and I would again caution the new traders from trying to short it and instead look for bottom-end patterns. So what are the important things to me in a bull market? And to me, junk bonds, this is high yield securities, these are fresh highs again. And this is important because junk bonds correlate very highly to the stock market. And I think that if the junk bonds were not making fresh highs, then I would be definitely worrying, because that would be a true divergence that for me would be worrisome. Again, not all diversions, even junk bonds diversion from stocks sometimes do not mean that we're going to have a bear market. But it at least is more important, I think. Here are the junk bonds on the weekly time frame, again, fresh highs, and I still don't see top-end pattern here. Even back here in November of last year, maybe this was a top-end pattern, but I guess it was more of a buying opportunity, if anything. So again, the junk bonds correlate highly to the general market, and I think right now, since they're both making highs, I see no big issues in the stock market. Even moving on to TLT, so we kind of have like everything is moving higher. So we got bonds moving higher and stocks moving higher. And here's TLT, 20+ year Treasury Bond Fund. Very oversold. This deeply oversold bounce likely actually was from previous videos. I didn't move it, so we got a bounce. And now we're moving towards 2017 highs. So here's TLT on a weekly time frame. Quite pretty nice bullish candlestick. Ideally, we would have had even a more if the close was even closer to the high, but it's pretty bullish. It's pretty good looking candlestick. So I think this bearish engulfing more or less has been reversed. And this is a weekly bearish engulfing, so it's more important than daily bearish engulfing. Here's LQD and investment grade corporate bonds, and notice this one also kind of got sold off, but notice that we had a bunch of hammer-like candlesticks in this 119.75 area, and then a gap. So that was like a giveaway that we pretty much have bottomed, and now we're moving higher. And notice that these are fresh highs. In fact, these are all-time highs. This is an adjusted chart. So in other words, the chart is adjusted for dividends. So here it is on a weekly time frame, LQD. All-time highs. So this bearish engulfing more or less has been reversed. Again, this is a bullish chart, so I would avoid looking for top-end patterns. I would instead look for bottom-end patterns and go long. Okay, let's move on to the Forex Universe. Here's currencies, US dollar index on a daily time frame. Two support breaks, one in May here, the other one back just recently in June of this year. It's a very classic kind of thing when we have a support break, a surge higher, we tapped out exactly at support break, and then just unraveled to fresh lows. These are indeed 52-week lows, so I no longer think of US dollar as bullish. I think we're now in a bear market for US dollar. So we could look for opportunities to short it if you so desire. I don't trade currencies, so it's a moot point regardless. But here's US dollar on a weekly time frame. So first of all, multi-year highs here, and I thought we had a true breakout. In fact, if you listen to my videos, I was pretty certain that we were going to continue higher, and this pullback was just a normal retest of breakout. Clearly, it was not. We had a breakout, multi-year highs, and then we just lost this momentum. Support breaks here below 99 points. Continued lower. Finally, we retested November lows, and this retest clearly failed because we broke below them and continued lower. So now this is a 52-week lows, and that's not a good sign. I think I'm going to start treating US dollar as bearish. British pound, maybe this is a breakout here in April or May of this year. Maybe this is a breakout, and now we have a new. I guess this is it could be like a reversal. We had a reversal, and now we have continuation of that reversal. Especially if we get to 52-week highs, then I think we can say that we're now in a bull market for a British pound. Euro versus US dollar. This is a daily time frame. Kind of showed a strong buying pressure here. We had a gap back in April, continued higher. Notice we found support around 200-day, and then continued higher and surged to 52-week highs. Also had a 50-day over 200-day moving average cross. So multiple indications of change in trend. So when you have for example, this is Euro versus US dollar in the weekly time frame, we had clearly bear market. So we had from 2015 a bounce. This I would have shorted it, another bounce. I would have shorted it again, and fresh lows here. But now we kind of stopped falling, rallied, and then we had this gap, and that's the gap I just showed. This was the first indication that there is now significant buying present, and this was one of the. So this was like a first sign of bottoming action. So this was okay, great. Now we have something that is, a few signs of the change in trend. Then I had another sign of a change in trend right there with this gap. We had another sign of a change in trend with the 50-day going above 200. We had another big surge here. This was a pretty decent sign that we're having a change in trend. And finally, we continued to surge to 52-week high. So we now have a change in trend, and I think Euro is going to be, making fresh higher highs and higher lows from here. We are coming up on a strong resistance in 1.1711. So there's a lot of resistance here, 1.16, 1.17. If Euro manages to get up there and break above those strong resistance, I think we could see a significant move higher for Euro. Now let's see if it does that or not. Finally, here is just I occasionally look at US dollar with Canadian dollar. It looked like a series of higher lows and higher highs, but maybe this was a big bearish wedge. So we had a plunge and now a bear wedge, and now we definitely have a bear wedge break to the downside. So you never know exactly how this is going to pan out, but looks like Canadian dollar is winning this trade, this war. Okay, let's move on to gold. I do trade gold at MasterChartsTrading.com, and myself I have a position on GDX still open. So the US dollar is dropping. US dollar correlates negatively to gold, which is a normal correlation. Gold is rising, US dollar is dropping, so this is a normal correlation. Here, I'll show you on the next chart, but this is gold continuous contract, so it looks like we have a couple of weeks of non-stop gains basically as the dollar continues to unravel. Could we see a pause? Absolutely. Like I just showed with euro, maybe we're approaching a resistance for euro. Maybe euro will run into resistance, and this will give dollar a little bit of a breathing room, and at the same time gold might maybe consolidate sideways or maybe even drop. We'll see. I think GLD kind of shows a better picture here, because I wanted to show that I think we had a bear trap here basically in the beginning of July, when we had a drop below the previous recent lows and a close below those lows right there in July 9th here. But then almost immediately we rallied above the previous close and then continued higher. Now, if we continue higher, we have still strong resistance here for GLD at the 123, 124 area. So we'll have to watch and see if we get there and if we break above. My money is on the long side. I think gold is bullish right now. Here's gold on the weekly time frame. Notice a couple of, I think these are very bullish candlesticks. We have nice hollow candlesticks and another nice big hollow follow through this week. So the area where we'll see resistance, I think, would be somewhere around 1300, 1340, around here. But we'll see where we'll get there basically. Here's GDX on a daily time frame. Again, this one is actually slightly stronger, so whereas GLD dropped below the May lows, GDX actually moved higher. And you see now it's approaching 200-day moving average. Previously, the 200-day moving average acted sort of like resistance in the previous points here back in March, in April, and also in June of this year. So if we close above that 200-day, and then hopefully the 50-day will catch up, and then maybe we'll see a bullish cross, a golden cross, and that's usually a good sign. Here is GDX in a weekly time frame. Notice I pointed out a few weeks ago that we had a inside week with a bearish resolution. So we had the end of June week here was range was within the previous weeks, and we had a clear break with a gap down. But now we have the opposite. Now we have a bullish engulfing that is confirmed. So we have a bullish engulfing on a weekly time frame with a confirmation. So sometimes it's difficult. Well, it's always difficult, but sometimes it's even more difficult to see and to read into those candlesticks. So it's not always, like I try to kind of take them all together. I don't try to read too much into individual candlesticks. Finally, here at GDX on the daily time frame with a few of my private indicators. Percentage of stocks on the buy signal, GBI, gold breadth index, raw data, and intermediate term breadth momentum oscillator. So two important points here. We were oversold on these two indicators here. And notice that we surged following the some kind of a bullish pattern basically. So we had a more or less bullish engulfing here on the daily, another bullish engulfing here. Notice that this one failed and we've moved below the previous low. That is why I don't put my stop. So if I was to buy right there in June, mid-June, I don't put my stop below the immediately previous swing low. I give my stop significantly more room to be proven wrong, and this was a good thing because it looks like we're now moving higher again. So overall, I think gold is bullish, and hopefully we'll see further follow through. Okay, let's move on to harder commodities. Here is West Texas Intermediate, light crude oil on a daily time frame. So this one is a little bit more difficult chart, so it's not as clear, obviously. Now, I feel like we're not yet overbought enough to warrant a short entry. Now, again, I could be completely wrong, and we could just unravel and continue lower from here, because these two candlesticks here on Thursday and Friday, they are very bearish. You can see that this is a shooting star kind of candlestick together with a very large red candle. Overall, together, this is not a good sign. Now, but for my taste, I would like to see oil even more overbought. So ideally, we could maybe get to like into the low 50s here, and then I would consider shorting it. Right now, it's just kind of in between. But then again, I could be wrong. Maybe it was just a shallow pullback. So we'll see. Basically, long term, to my taste, West Texas is in a downtrend, and this bounce here. Maybe this is a rising wedge. So we have a drop and now a rising wedge, and then we get a rising wedge break and fresh lows. I don't see oil going higher. I mean, unless something happens, and I don't know what it could be. Here's energy, XLE. This looked very hopeful for the energy bulls and for oil bulls. Notice that we were able to close above the 50-day moving average here just in June here, and 3 days ago. But then we are again rolling over. So approaching 52-week close, very close to 52-week close for XLE. This is a weekly time frame for XLE right there. Our 52-week close just a few points away from current prices. Here is we're graphed together with West Texas. I showed the chart in the past already, so notice that two very similar patterns, one in 2015, one currently in 2017. XLE just continues to slide until we get 52-week close, and then oil also unravels. Similar kind of picture. We're sliding. We're very close to 52-week close. I wonder if oil is going to unravel again this time. Look at natural gas. This is a daily time frame for natural gas. Very choppy chart. Again, I don't recommend this to beginners. I think this is a bullish chart because there's a 52-week highs here, and with a very deep pullback, surge, another pullback, wild action, jumping around like there's no tomorrow, going back and forth. Again, continue back and forth. So very tough chart to trade, honestly, but if you're so inclined, we do trade it at MasterChartsTrading.com. And this is a weekly time frame here. I think this is the reason why I think this is a bullish chart. We had a surge here back in 2016, breakout, 52-week highs, throwback, 52-week highs, another throwback, another 52-week highs, another throwback, and now we're making a lower. We made a lower high, and possibly now we're making a lower low, unless we surge from here. So if we do not surge and continue lower, this could be a head and shoulders, but it hasn't happened yet. So I still treat this as a bullish chart, and we trade it on the upside. Alright, that's it for this week's recap. If you like what you're hearing, please do hit the like button. It would mean a lot to me if you like this video. If you have any comments, please share them below. And of course, if you have a Twitter, Facebook, or any other or StockTwits accounts, please share this video with others. Thanks for watching, and please stay tuned on how to find us on the internet. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.